How about a way to reduce your risk while at the same time optimizing your gains? And on top of that, shortening the amount of time that your capital is tied up in the market. That's what I'm going to show you how to do today. Hi, I'm Matthew Carr, Chief Trend Strategist for the Octa Club, and welcome to this episode of Market Trends. Like every red-blooded human being on this planet, I enjoy playing video games. I grew up playing video games. I play video games to this day. In fact, you can even find me playing Rocket League in the evenings with my nephew. And video game stocks are some of my favorite plays. In fact, across my various publications, my readers are involved in 4 different video game and esports companies, and the gains range from the single digits all the way to more than 700%. But few companies have been more rewarding over the years than Electronic Arts. Right now, shares are trading right below their 52-week high, and they're about up 14% year to date. So that's not a barn burner. And since January 1st, 2017, EA shares have gained roughly 55.36%. We'll just call it 55.4%. Now, that does outperform the S&P 500 during that stretch, but it's an underperformance of the NASDAQ. So all in all, as a long-term hold, EA has been kind of like, eh. But for me, it has been not only one of my favorite plays to trade over the years, but it's also been one of my most profitable ones. In fact, during that same stretch from 2017 to today, I have closed out 11 out of 13 positions in EA for gains. I did have 2 losses. 6 of those positions that were closed out were for 100% or more, with 3 of those for 450% or more. On top of that, that doesn't include the fact that my readers are still sitting on a 30% gain in their shares, and we have calls that are up more than 200%. So that means potentially I have a baker's dozen of profitable gains on this one position over the last several years. These are the nice, consistent types of plays that I love to trade. So how did I accomplish it? That's the big question. Well, for the past 7 years, I've been running this very successful investment research service, which I'm going to share some of the strategy with you today. And I'm going to go over the basics so that you can kind of apply this same technique to your own portfolio and really see the returns. Now, there's this belief from investors, or this hope, that you're going to buy shares in a company and then over time it's going to steadily move higher. Now, of course, along the way, there's going to be like these bumps and bumps in the road, but those are just the normal ebbs and flows of a healthy market. Well, first off, I want you to go ahead and just kind of throw that idea away, because the reality is most companies, their shares have a tendency to move asymmetrically. So what does that mean? That means that within a given year, a company's shares will have good months, sometimes even exceptional months, as I'll show you, and they'll have bad months. Now, this isn't random either, because what you'll see is that usually it's the same months year in and year out that these companies perform well and that they perform poorly. And more often than not, it relates back to that company's business, its earnings, and its revenue. This is the crux of seasonal trading. And in seasonal trading, what we want to do is we want to focus on the best and forget the rest. So let's take a look at EA's best and worst months over the past 5 years. And you'll see why I always buy June calls on Electronic Arts. So this is the data that's compiled from my system. Right off the bat, it's pretty obvious. You can see right there that January shares are averaging a 7.58% gain each year over the past 5 years. So the second best month. And then we have May. This is a great month for shares, where shares are averaging a 12.14% gain over the past 5 years. Those are your good months. That right there, the January and May. Then we look out and we see that August, October, and November are these consistently down months. Now, this isn't a fluke or an anomaly, all right? So keeping in mind that in seasonal trading, we want to focus on the best and forget the rest. When we look at those months, August, October, and November, we don't care about EA shares there. We actually want to see them fall. We want their releases to be hammered by the press. That we want to see them miss on first quarter and second quarter results, which are reported around then, we want analysts to downgrade shares because right after Christmas, that's where EA shares have this tailwind. You know, everybody got money for Christmas. They started doing digital downloads. And then at the end of January, EA reports third quarter results. This is the company's most profitable quarter of the year. Shares do very well on this report. And as we can see, it does very well on that month. In May, EA reports fourth quarter results. This is its second most profitable quarter of the year, but it's also its best received, right? In fact, over the past 10 years, shares of Electronic Arts have averaged a one-day pop of 5.4% on this report, and 5 times surged 8.8% or more. That's what contributes to that 12% average monthly gain we see in May for these shares over the past 5 years. And that is why I buy those June calls, because I want to take advantage of that updraft. Now, when we look at EA's fundamentals, we see this sawtooth pattern that I like to see in all sort of seasonal trading. And what I mean by this sawtooth pattern is just what I said before, that third quarter, there's that most profitable quarter of the year. There's that big spike. Fourth quarter, that's its second most profitable quarter of the year. There's a step down, but it's still very good. And EA has a tendency to beat expectations. And what you'll see is shares following behind it will follow along this sawtooth pattern. And when investors hear those first quarter results, where you've seen this big step down, not only in revenue, but also earnings, shares will then struggle over the next few months. This is the sort of straightforward strategy that I've used on EA shares over the past several years. And this is how I've been able to score a baker's dozen number of wins. In fact, 7 of those gains are for 100% or more. Like I said, 6 we've already closed. 1 that we're still sitting on, and our biggest winner was 541%. So what I want you to take away from this is to remember that shares of companies tend to move asymmetrically. There are going to be good months and there are going to be bad months. You just have to figure out which ones they're going to be. Seasonal trading, this is one of the easiest and quickest ways to score big gains. And it's even better because your holding periods are going to be just a few months. You're not exposed to these long-term whipsaws in the market. For instance, with EA, I start looking at those shares in December, at the end of December, because I want to take advantage of that January move. And then if I don't make it at that point, anytime between January and May, that's where I'm looking to get in on a dip and just, again, to buy those June calls, because that has proven time and time and time again to be winners, not just for me, but also for my readers. I'm Matthew Carr, Chief Trend Strategist for the Oxford Club, and thank you for watching this episode of Market Trends. You know, for more information like this, I actually provided a link to a presentation that I did. It's on a similar type of play, and I'll give you the ticker symbol in that presentation, so be sure to check it out. Until next time, here's to high returns.